Welcome back to another episode of Pie Uncut. Let me ask you this. What if I told you that some of the best opportunities in artificial intelligence aren't in the obvious winners like Nvidia or Microsoft, but in the so-called losers? Yes, the very stocks that Wall Street has been dumping this year. Companies that investors believe AI will disrupt or even destroy might actually be the most attractive investments for long-term contrarians. Today we're going to talk about 5 of these underdog stocks. ServiceNow, Salesforce, Sage Group, FactSet Research Systems, ABM Industries. They've all taken a hit because of AI fears. But when you peel back the layers, you start to see that the fears may be exaggerated, the risks misunderstood, and the upside underappreciated. So grab your coffee, because this is going to be a deep dive into contrarian AI investing and why betting on the underdogs could be the smarter play. Segment 1, setting the stage, AI winners versus AI losers. Let's zoom out first. In 2025, the stock market has been dominated by a handful of AI winners: Nvidia, Broadcom, Microsoft, Alphabet, Meta, and Oracle. Together, these 6 stocks are up about 40% on average this year, and the reason is simple. They are the backbone of AI infrastructure. Nvidia makes the GPUs. Microsoft and Google run the hyperscale cloud. Meta and Oracle are aggressively pivoting into AI workloads. Investors love these stories. They're clean, they're easy to understand, and they're backed up by earnings. But here's the thing. Not everyone can be a winner. While these names grab the spotlight, a quieter story is unfolding. Dozens of companies, many of them in software and services, are being punished because investors fear I will eat their business models alive. Think about Adobe. The company is a household name in creative software, yet its stock is down 20% this year, even though net income is up 36%. Why? Because investors worry that AI can now generate images, videos, and designs, undercutting Adobe's tools. That's the paradox of 2025. AI is creating both massive winners and dramatic losers at the same time, and that's where contrarian opportunity comes in. Segment 2, ServiceNow, now, the workflow giant. Let's start with ServiceNow. This is a cloud software platform that helps enterprises automate workflows. Things like IT service requests, HR forms, and even supply chain processes. Now, ServiceNow stock is down more than 10% this year. Why? Investors think AI will replace its platform. After all, if ChatGPT can generate code or automate workflows, do you still need ServiceNow? Here's why I think that view is short-sighted. Integration moat, ServiceNow isn't just a tool, it's part of the backbone of enterprise IT. Rip it out, and you're asking a Fortune 500 company to overhaul its entire workflow system. That's not happening overnight. AI complement, not replacement. ServiceNow is embedding AI directly into its platform. Think of AI co-pilots that automatically route IT tickets or pre-fill HR requests. Instead of replacing ServiceNow, AI makes it more valuable. Enterprise inertia. Big companies move slowly. They don't experiment with untested AI workflows on mission-critical processes. They stick with trusted platforms. So while ServiceNow looks like an AI loser today, it's really positioned to ride the AI wave as customers adopt AI features built into its trusted ecosystem. For long-term investors, that 10% dip might look more like an entry point than a warning sign. Segment 3, Salesforce, CRM, still the king of CRM. Next up, Salesforce, the company that basically invented the modern concept of CRM, customer relationship management. Sales, service, marketing, all run on Salesforce. Yet the stock is flat, down about 1% since August. The concern? That AI chatbots and virtual agents will take over the job of sales and support, making Salesforce irrelevant But let's take a closer look. Data gravity. Salesforce owns mountains of customer data, the kind of data AI feeds on. If anything, Salesforce is in the perfect position to monetize AI. Einstein AI Salesforce already launched its AI assistant, Einstein. It can draft emails, summarize calls, and recommend next best actions, all inside the Salesforce ecosystem. High switching costs. No large enterprise is abandoning Salesforce just because a chatbot exists. The platform is too deeply embedded. The way I see it, Salesforce is like a landlord in the digital economy. Businesses can't function without their CRM systems. And when AI becomes critical, guess what? They'll want AI inside the systems they already use, not in some standalone chatbot. That makes Salesforce less of an AI loser and more of a sleeping AI winner. Segment 4, Sage Group, the international underdog. Now let's cross the Atlantic and talk about Sage Group, a UK-based accounting and payroll software company. Its shares are down 15% in London and about 8.5% in US trading this year. Investors are worried that I can automate bookkeeping and payroll, core Sage functions. But here's the contrarian case. Stickiness. Once a small business adopts Sage, they rarely leave. Accounting and payroll systems are too tightly tied to compliance and taxes. AI as a feature, not a substitute. Yes, I can generate invoices or reconcile receipts. But payroll and compliance require accuracy and integration with government systems. That's where Sage shines. Valuation discount. Sage trades at 23 times 2026 earnings, cheaper than Intuit, and below its own 5-year average. So you've got a global software provider in a sticky business trading at a discount. That's exactly the kind of profile contrarian investors should love. Segment 5. FactSet Research Systems, misunderstood data provider. Let's turn to FactSet Research Systems, the financial data provider. FactSet stock has fallen off a cliff, down more than 40% this year. It now trades at 16 times earnings, its lowest valuation in 15 years. The fear? That AI tools like ChatGPT will give away financial data for free, rendering FactSet obsolete. But let's reality check that. Regulation. Financial firms can't rely on free AI tools for compliance and audit purposes. They need verified, auditable data streams. Integration. FactSet is deeply integrated into client workflows. Traders, analysts, and bankers don't just pull data. They rely on FactSet's analytics and models. Analyst support. UBS recently upgraded FactSet to a buy, arguing that fears are overdone. Banks move slowly, and FactSet is still a trusted partner. In short, FactSet isn't going away. If anything, it's been oversold. Contrarians who buy here could be getting a world-class data provider at a bargain price. Segment 6. ABM Industries, the low-tech play. And finally, let's talk about a company you might not expect in an AI discussion, ABM Industries. ABM provides facility management, janitorial services, engineering, maintenance. It's not a flashy tech name, but investors worry that robotics and AI could automate cleaning and maintenance, hurting ABM's labor-driven business. Here's why that concern may be overblown. People-first business. ABM CEO said it himself. I will not disintermediate their core business. You still need people for most facility work. AI as an efficiency tool, where AI can help, is in optimizing schedules, reducing waste, and generating new leads. That boosts profit margins instead of killing demand. Valuation. ABM trades at just 12 times 2025 earnings, with a market cap under $3 billion. That's cheap for a company with stable revenue and the potential for AI-driven efficiency gains. So while Wall Street yawns at ABM, it could quietly deliver steady returns, the kind contrarians love. Segment 7. The bigger picture. Why contrarians win. What do all these companies have in common? They're being painted with the broad brush of AI disruption. Investors assume, I will replace them, so they sell first and ask questions later. But as history shows, markets often overestimate short-term disruption and underestimate long-term adaptation. Remember 2000? Everyone said Amazon was doomed when the dot-com bubble burst. Apple was struggling to survive. Both were written off as losers. 2 decades later, they're trillion-dollar giants. The same could happen here. Today's AI losers may be tomorrow's AI-enabled winners. Segment 8. Risks to watch. Of course, no contrarian play is risk-free. Here are the big ones to consider. Faster AI adoption. If enterprises adopt AI faster than expected, disruption risk rises. Competitive threats. Startups may emerge that challenge incumbents with AI-native solutions. Valuation traps. Just because a stock looks cheap doesn't mean it won't go cheaper. Patience is required. That's why position sizing and diversification are critical when betting on contrarian plays. Segment 9. Actionable takeaways. So what's the playbook here? If you're looking for AI-enhanced workflow winners, consider ServiceNow. If you want a CRM powerhouse with data advantage, look at Salesforce. For international value, Sage Group is worth a look. If you like deeply discounted data providers, FactSet is compelling. And if you want a low-tech contrarian, ABM offers quiet upside. The key is not to chase hype, but to find value where others see fear. Closing thoughts. AI is the defining theme of this market cycle. But it's not just about the obvious winners. Sometimes the best opportunities lie in the overlooked, the underappreciated, and yes, the so-called losers. As contrarians, our job is to separate real risk from imagined fear, and to see value where the crowd sees only danger. So next time someone tells you AI is going to destroy ServiceNow, Salesforce, Sage, FactSet, or ABM, remember that history is filled with companies that adapted, survived, and thrived when the world thought they were finished. That's the opportunity. That's the contrarian edge. And that wraps up today's episode. If you enjoyed this deep dive into contrarian AI investing, make sure to subscribe, leave a review, and share it with a friend who loves finding hidden gems in the market. Until next time, stay contrarian, stay curious, and keep investing smart.